when we buy stocks or equities of another company, we can account for them in a few different ways. And how we account for them depends on our intentions. And our intentions are going to depend on how much we own. If we own less than 20%, we're going to presume that our intention is to make money either by buying low and selling high or collecting dividends. If we own between 20 and 50%, we're going to presume that our intention is to exercise significant influence over that other company. And if we own more than 50%, we're going to presume that our intention is to control that other company. And that's going to determine how we account for these investments. Probably the first thing we should talk about is that after 2017, there's no longer available for sale stock investments. There are available for sale debt investments, meaning we bought the bond, we're not going to actively trade it, we'll sell it when we need the cash or we think the time is right. There used to be that kind of category for equity investments, and so unrealized gains or losses didn't hit the income statement. That's no longer true after 2017. After 2017, every stock investment is treated as a trading investment. All right, so we said at the beginning that how we treat our investment in another company when it comes to stocks depends on our intention, and that's determined by how much we own. So if we own between 0 and 20%, there are really three different ways we could treat it. One is just the straight vanilla cost method. We buy stock in a small company that isn't actively traded. So we put it on our books. We can't mark it to market. We don't know how much it's worth after that because it's so small and it's never traded. And then when we sell it for more than we pay, that's a gain. We sell it for less than we pay, that's a loss. The other way to treat an investment in where we own between 0 and 20% of the other company is to market to market. So it's an actively traded investment. We know what it's worth, so we'll mark it up or down on our balance sheet, and those unrealized gains or losses will show up on our income statement. So we own a share of stock that's worth $100 when we buy it, and at the end of the first month it's up $10. We'll book $10 worth of net income. It'll hang out in other revenue and gains, even though we didn't sell it. And of course, that net income will close out to retained earnings. In the old days, there used to be available for sale stocks, and those unrealized gains or losses were in other comprehensive income, just like they are in available for sale bonds, but those days are behind us after 2017. And the final way to account for this kind of investment used to be more significant before 2017. It's called the fair value option. Anytime we buy a financial instrument, whether it's a note payable, a note receivable, or a stock or a bond, we can elect at the time we acquire it to call it a fair value security, and we'll mark it up and down in value, and those gains or losses will show up on our income statement. Well, that's exactly the way we treat trading securities nowadays. So if we own between 0 to 20% of another company and they pay us a dividend, we'll debit cash, credit dividend revenue. However, if we own between 20 and 50%, it's presumed that we can exercise significant influence. So we can get them to pay us a dividend anytime we want. So maybe that's not the best way to measure our revenue. So instead, we're going to do the equity method. The equity method says their income is our income. If they make $1 million and we own 25% of them, we'll book $250,000 of revenue on our books by debiting that investment on our books for $250,000 and crediting some kind of revenue account, something like revenue or income from equity method investments. So please keep in mind, they don't owe us $250,000. They don't give us $250,000. We didn't make $250,000. They did, but we increased the investment on our books and booked some revenue for $250,000. Also, when they pay us dividends, we're going to act like they're cashing us out. So we'll debit cash and credit our investment in that company. And finally, if we own over 50%, that means we control them. So we are one entity for accounting purposes. So we should report ourselves as one entity to the outside world. So we'll take all their revenue and all their expenses, we'll take all the accounts on their balance sheet, and we'll combine them with ours. And we'll present one set of financials to the outside world. Now, if we don't own all 100%, if we own 90%, say, we'll break out the 10% we don't own. That's called the non-controlling interest. That's the part that doesn't control the sub. We own 90%. Somebody else owns 10%. So we'll break that out on the income statement and the balance sheet. So how we count for an investment in another company depends on how much we own. Less than 20%. If we can't market to market, it stays on our books for what we paid for it. If we can market to market, if we can know exactly what it's worth or make a good guess at what it's worth, we'll mark it up and down in value with the unrealized gains or losses actually appearing in net income. If we own between 20 and 50%, we'll use the equity method. Their income is our income. And if we own more than 50%, we'll present a consolidated balance sheet to the outside world. Hope that helps.